The US government has been issuing unprecedented amounts of new bonds. That has increased the supply significantly, and that's what's driving this big decline in bond prices since the pandemic. But that's not all. See this chart? It shows the amount of US debt coming due. This massive spike here means that the US is facing $7 trillion in debt coming due this year in 2025. It's known as a maturity wall. And the only way the government can afford to pay for it, you guessed it, is by issuing more bonds, taking on more debt. That will only increase bond supply even more, driving down prices further. And what about demand? There's no sign that it's rising, because even though as bond prices fall, yields rise, they haven't risen enough to compensate for the rising risk of investing in US Treasuries. Here's one way to look at that. The term premium. The term premium is the extra return investors expect for locking up their money in a long-term bond, like a 10-year treasury, instead of just holding short-term treasury bills for the same period. It's all about the risk of tying up your cash for a decade. Historically, it's hovered around 1 to 2%, meaning investors wanted to take a little more reward for taking that chance. But from 2016 to 2024, the term premium went negative. Investors were actually giving up returns to hold long-term government bonds. Why? Well, back then, inflation was low. The Fed kept interest rates at zero, and they were buying lots of bonds through quantitative easing. This made long-term bonds feel safe and attractive, even without the extra return. Now, since October 2024, the term premium has turned positive, hitting 0.9 percentage points today. This means investors are starting to demand higher returns for long-term bonds again. This signals that bonds are seen as riskier, and investors want compensation for that. This is because inflation is still hanging around. Central banks aren't buying bonds anymore, and the US government is issuing tons of new bonds to cover deficits. If this keeps up, say the term premium rises to 1.5%, yields on 10-year bonds could rise even more. And because bond yields and prices move in opposite directions, that spells a further drop for bond prices. And that could be devastating for the economy.